When it comes to trading, identifying trend continuation patterns can make all the difference between catching the next big move, or missing out entirely. These patterns help traders spot when a trend is simply taking a pause, rather than reversing, offering high probability entry points with the trend. Welcome smart traders. In today's video, we're diving into the world of trend continuation patterns. What these patterns are, the different types, and most importantly, how to trade them effectively using real market examples. So let's get into it. Let's begin with the bullish flag pattern, a trend continuation pattern that forms when the price makes a strong upward move, known as the flagpole, followed by a period of slight downward or sideways consolidation, creating a downward sloping channel called the flag. The flagpole represents aggressive buying and strong bullish momentum, while the flag reflects a temporary pause in the trend. The upper and lower trend lines of the flag outlines the consolidation area. The bullish flag typically appears within an ongoing uptrend and signals a short pause before the trend continues upward. Once the price breaks above the flag's upper trend line, there is high probability that uptrend may continue. Moving on, let's explore the bearish flag pattern, that forms when the price makes a strong downward move, known as the flagpole, followed by a period of slight upward or sideways consolidation, forming an upward sloping channel referred to as the flag. Two trend lines are drawn to define the flag structure of the consolidation area. The bearish flag typically appears within a downtrend and indicates a brief pause before the bearish trend resumes. Once the price breaks below the lower trend line, it signals a high probability continuation to the downside. Now, let's take a look at a real market chart to see how the bullish flag appears in action. In this scenario, the market is in a strong uptrend, and we can see that after a sharp upward move, the price enters a brief period of consolidation, forming a downward sloping channel. We wait for a confirmed breakout before taking action. Eventually the price breaks and closes above the upper trend line of the flag, signaling a high probability continuation of the bullish trend. This breakout presents a potential entry point for a buy position. Place your stop loss just below the most recent swing low within the flag pattern. Measure the length of the flagpole and project that distance upward from the breakout point for take profit. In this next chart, we can clearly identify a bearish flag pattern forming during a sustained downtrend. After a strong downward move, known as the flagpole, the price enters a brief upward sloping or sideways consolidation, forming the flag. We wait for a confirmed breakout to validate the pattern. As shown in the chart, the price breaks and closes below the lower trend line of the flag, which acts as a confirmation signal and presents a potential entry point for a sell position. Place your stop loss just above the most recent swing high within the flag. For take profit, measure the height of the flagpole, from the start of the move to the beginning of the consolidation, and project that same distance downward from the breakout point. Next up is bullish pennant, a highly effective trend continuation pattern that begins with a sharp and impulsive upward move, known as the flagpole, which reflects strong buying pressure and bullish momentum in the market. Following this powerful rally, the price enters a brief consolidation phase, forming a tight, symmetrical triangle known as the pennant, where price action contracts within converging lower and upper trend lines. Despite the consolidation, the underlying sentiment remains bullish. The bullish pennant suggests that the market is simply gathering strength before making another decisive move higher. The pattern is confirmed when the price breaks above the upper boundary of the pennant, ideally accompanied by a surge in volume, indicating renewed buying interest. On the other hand, the bearish pennant emerges after a steep downward move, known as the flagpole, which reflects strong selling pressure in the market. Following the flagpole, the price enters a brief consolidation phase, forming a small symmetrical triangle, known as the pennant, where price action compresses between converging trend lines. This phase indicates temporary indecision or a pause, as the market consolidates before potentially continuing lower. The pattern is confirmed when the price breaks below the lower trend line of the pennant structure, ideally accompanied by a surge in volume, signaling that sellers have regained control. Let's examine a real market chart that illustrates how a pennant pattern typically forms. In this case, we can observe a bullish pennant forming during an uptrend. The pattern begins with a sharp upward move, known as the flagpole, followed by a brief consolidation phase where price action tightens within converging trend lines, forming the pennant. We wait for the price to break above the upper trend line of the pennant to confirm a potential continuation of the bullish move. The breakout is considered valid once a candle closes decisively above the upper trend line, ideally supported by increased trading volume, which adds strength to the signal. This breakout presents a potential entry point for a buy position, as it indicates a high probability that the uptrend will continue. Place your stop loss just below the recent swing low within the pennant, and to set your take profit, measure the height of the flagpole and project that distance upward from the breakout point. Now let's dive into the ascending triangle pattern, a bullish continuation chart pattern that forms when the price repeatedly tests a horizontal resistance level while forming higher lows, supported by a rising trend line. This pattern suggests that buyers are gradually gaining strength, consistently pushing prices higher, although they face resistance at a specific level. The converging resistance and rising support form a triangle-like shape, with pressure building toward a potential breakout. The pattern is confirmed when the price breaks above the horizontal resistance line, signaling a high probability that the uptrend will continue. Following, we have the descending triangle pattern that forms when the price repeatedly tests a flat support level while creating lower highs, contained by a descending upper trend line. This pattern indicates that sellers are gradually gaining strength, consistently driving prices lower, although they encounter buying pressure at a key support level. The converging support and falling resistance create a triangle-like structure, with momentum building for a potential breakout. The pattern is confirmed when the price breaks below the horizontal support line, signaling a high probability that the downtrend will continue. To understand this better, here's a real chart example of the ascending triangle in a trending market. In this scenario, the price is in a strong uptrend, and an ascending triangle has formed, characterized by a horizontal resistance line at the top and a rising trend line of higher lows beneath it. This structure indicates that buyers are gaining strength, consistently pushing the price higher against a key resistance level. We wait for a confirmed breakout to validate the pattern. As shown in the chart, the price breaks and closes above the resistance line, which serves as a confirmation signal. This breakout presents a potential entry point for a buy position, as there is a high probability that the uptrend will continue. Place your stop loss just below the most recent swing low inside the triangle pattern and use a measured move approach by projecting the height of the triangle upward from the breakout point for take profit. Next, we turn our attention to the symmetrical triangle that forms when the price makes lower highs and higher lows, creating two converging trend lines, one sloping down and the other sloping up. This pattern represents a balance of power between buyers and sellers, with neither side in clear control. As the triangle narrows, market pressure builds, often leading to a sharp breakout. While the symmetrical triangle can break in either direction, it typically favors the direction of the existing trend. The pattern is confirmed when the price breaks out of either the upper or lower trend line, with a breakout in the trend's direction indicating high probability of continuation. The symmetrical triangle is confirmed when the price breaks out of the triangle with strong momentum and increased volume, indicating a high probability of a sustained move in the direction of the breakout. Let's examine a real market chart example, as we can see a symmetrical triangle pattern has formed, indicating a period of consolidation and indecision within the prevailing bearish trend. As the triangle narrows, we patiently wait for a breakout to confirm the next potential move. Eventually, the price breaks below the lower trend line of the triangle, signaling a likely continuation of the bearish trend. This breakdown presents a potential entry point for a sell position, as the momentum shifts back in favor of the sellers. Place your stop loss just above the most recent swing high. Project the height of the triangle downward from the breakout point for a take profit target. Thanks for watching, and remember, success in trading comes from discipline, resilience, and mastering your emotions. Every trade is a lesson. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. See you in the next one.